Your next guest is looking at the options market as a way to limit some downside risk. That would be Jeff Kilburg, KKM Financial, on set. I love it. Everybody's on set. Jeff, thanks for coming in. How do we do that? How do we protect ourselves?
Well, Sully, you're absolutely right. It's getting a very noisy environment. We are seeing a lot of really smart folks come out and talk about downside protection. So I want to use SPY. That's the S&P 500 ETF. And if you think about the notional value, if you were to sell one options contract, that's basically hedging out slowly about $67,000. For all the folks out there with a $250,000, $250,000 portfolio, maybe you would put 4 spreads on here. But what I'm doing is I'm picking 5% above, 5% lower, Sully. So I am going to finance this downside protection. When you buy insurance for your home, you just have to shell out the cash. Here, I am saying I don't think the market's going to go up another 5% before New Year's Eve. So I'm selling the 700 call. I'm using that $7.75 to help me buy the 640 SPY put for the same expiration. Therefore, it's only costing $1. And if you need more than that, it doesn't matter because that put stops you out. So if you have $250,000 and you put 4 of these risk reversals on, you're completely hedged out. You don't have to sell your SPY. You don't have to take those capital gains. But in the event you think that the market is going to move higher and you're more optimistic than I even am, you don't have to sell the call. You just have to pay for all that insurance.
Does that give me, to your point about insurance, you have a car, you hope you don't get into a wreck. Sometimes things happen. The market may keep going straight up, but we got a lot of warnings. How does that protect us? The market goes down 15%. What does that mean?
So that's really important to understand is that I used a 5% band on this. 5% above, I'm going to sell that call, meaning I'm not going to participate if the market goes above more than 5%, but I'm also buying a 5% lower put. And that 640 strike is going to allow me to be stopped out, be hedged out without actually selling my stock. If the market moves 3, 4, 5, 6% like it did back in April, those options are going to be protective of that downside risk.
Jeff, what about the people that are we talked about this earlier in the show, overexposed on AI, and your portfolio has all these other stocks, AMD, NVIDIA, et cetera. Can you create a basket, an ETF, or to use a QQQ or something to that?
It's a great point, Surratt. And if you think about the top 5 names of the S&P 500 representing 35%, it's even more pronounced in the QQQ. So you could use the same strategy, 5% above, 5% lower. But I'm going to take the other side because we just heard all the emotion about everyone talking about Armageddon coming. If you think the market's going to melt up higher, which it easily could on this sugar high that Ken Griffin was talking about, you're not going to want to sell and cap that limit. You would just buy the put. Now, just like your house that you insure, so you don't call up your insurance agent at the end of the year and cuss him out because the house didn't burn down. You have to spend that money. So you have to understand what you're spending. But with the VIX right now going into 16 is down about 5% today. This is an inexpensive way to protect your downside in the event this AI sugar high does come off.
Well, Paul Tudor Jones, I want to be clear in that interview where he said we could have a blow off top. He also said that we could have, a strong rally into a blow-off top. So I want to be clear, Paul Tudor Jones.
And Goldman Sachs, Salman talked about a pullback maybe in 24 months. So there's a lot in there.
After another leg higher, right?
Yes,
so nobody's saying, we're not, maybe you could say it, I can't, this is going to happen.
And Jeff, maybe talk a little bit to the viewers about the VIX, right? Because you made a really important point that we get, but a lot of people don't understand because as the VIX goes up and down, what does that mean for the price of the options and the price for protection?
So for someone who's never traded the VIX, it's very simple. A VIX at 16 means all the option premiums, all the calls and puts being traded for the next 30 days in the S&P 500 are articulating the fact that we see the S&P 500 moving 1% either up or down. We don't know. But when a VIX is at 16, that's a 1% expectation. If the VIX jumps up to 32%, Surratt, as you know, that's a 2% expectation. So right now with the VIX suppressed, tethered to 16, Sully, we are really seeing a very inexpensive way to buy downside protection. Of course, you get less for the call, 5% higher than you have to pay for the put, but that's the skew. And now I'm getting a little wonky, but at the end of the day, the VIX gives you a measurement. It's all it is a calculation.
I got no problem with wonky. We have the RBI. We call it sometimes WBI, wonky but important. What do you make of a market that keeps going up? Not every day. Yesterday, we had a slight down day after 7 up days. Yep. The Nasdaq's up 1% right now. VIX is at 16.5. And, like Ukraine and Russia continue to escalate their war. Like, there's things that we don't know what China is going to do. The government is shut down, partially. And the VIX is at 16.5.
We've made 3 new highs in the S&P 500.
And we don't know where
Why doesn't anybody care?
It's just the way the market is moving. This is momentum, Sully. And I think if you talk about what's coming, the Fed interest rate policy, the continued cuts that we are going to see, we don't have any data, right, Surratt? We no longer have data to really, nor do they. So I think the continued move lower in the VIX is just going to pour into people chasing. Remember, Sully, we're going to the end of the year. There's a lot of underinvestors. There's a ton of cash on the side. A lot of people sold in April. They're going to have to chase that higher.